The broadcast is now starting. All attendees are in listen-only mode.
All right, welcome everyone. Happy Monday. Hope everybody enjoyed the weekend. Had a strong start to the week thus far for the markets. Big news coming out once again, similar to what we had last Monday with another vaccine maker, Moderna, coming out with some positive news. We'll get into the weeds on what all that means for the markets and how things are shaking out this morning. But first and foremost, just want to welcome everyone to another Nadex webinar. Doing a little bit of post-election analysis, although the election seems to be a distant memory now with everything else that's shaking out. And I also, a special shout out and welcome to those folks who are joining us today that are taking part in the first Nadex trading competition, our demo trading competition, which kicked off last night. A lot of excitement around that. We had just shy of 1,000 people entering the markets last night to trade overnight activity and kick this thing off. The competition is going to last the entire week with a variety of prizes. First place overall wins $5,000. Second place wins $2,500, and third place comes in with a $1,000 prize. And for those folks who weren't able to register for this week because registration is closed, we are going to be hosting these quite regularly moving forward. So we're excited to have those as a part of our offering, and certainly excited by that. So with that, let's go ahead and talk some markets. We'll show the disclaimer slide and pull that out for everyone. And again, just a reminder that everything we're discussing today, folks, is for educational purposes only. There's nothing that Dan, myself, or Guy are going to say that's should be construed as a recommendation in any way. They're merely examples and talking about what's happening in the world and how that impacts markets. So please enter the financial markets at your own risk. It's your money. Take care of it. Make your own decisions. Certainly don't rely on other people to make those decisions for you. With that, Dan, Guy, welcome. How are you?
Thanks, T. Hello, Dan. How are you?
Hey, Guy. Good morning. Good morning to the Nadex audience. Good morning to Travis. Thanks for setting this up. Guy, you know, you're coming in hot Monday mornings usually, and especially when there's exciting vaccine news. So let's just get our take. I mean, I know Travis mentioned that the election seems like a distant memory. There's still some stuff to talk about there, but what's your take quickly on the second consecutive Monday where we have some really good vaccine news?
Well, as a member of the human race, I think we all can say the news last Monday was fantastic, and I think this Moderna news sort of dovetailing that is wonderful as well. But you know, you have to sort of look everything through it with a grain of salt, and I'm not looking to throw cold water on this, but obviously we're talking about a vaccine. In both cases, it's probably not going to be distributed in earnest until the late spring, early summer of next year. So as I said on Fast Money last Monday night, I'll say again here, there's that Jimmy Cliff song, Many Rivers to Cross, and there are many rivers to cross from here until the late spring, early summer. With that said, obviously the market likes it a great deal. It liked it on Monday. There was follow through, and it seems to like it again today. But in terms of the charts and in terms of the market, we'll get into it. You wonder if we're starting to get a tad overextended here, Dan.
Yeah, I think, yeah, we're going to go to my Bloomberg screen here a little bit because we're going to do a lot of charting here. You know, here, hold on one second here, people. I'm, you know, like Guy, I'm kind of new to some of this stuff here. Listen, Monday, I think, you know, there was so much angst last week about the election and whether there was a concession by Trump and what that really meant, right? I think for policy going forward, I think it was important to remember that this vaccine information is really important at the moment because we have this virus raging throughout the country. We have daily caseloads exceeding those from the spring when it was really considered to be very, very hot. We have, while the mortality rate is much less, we're still averaging well over 1,000 deaths a day. So that's really important, you know, for anyone who's affected by this disease, despite the fact the mortality rate is lower. And then the other issue is that you don't want to catch this disease. They're what they're calling, you know, COVID long haul symptoms. So all of this news is great. There's been some good news on therapies, but I guess as far as the market's concerned, you know, last Monday on the Pfizer news, we gapped up, what, 3% or so, and then we ended up closing on the lows, maybe close to up 1% or something like that. We worked our way back through for the rest of the week. Let's just kind of go to the S&P chart. We'll talk about that because, Guy, I expect you're considering the fact that there could be a sell on the news, given that investors are going to start to price the fact in, is that the economy will not be back 100%, at least until the back half of next year.
No, and listen, I understand the euphoria, and I understand what happens in terms of the markets these days. A lot of times the machines take over, and you see headlines like this, and there's going to be obviously inflows like we have been seeing. But then you have to ask yourself, I mean, how much good news are we pricing in? And by the way, Dan mentioned the election. President Trump is still not conceded. There's still a lot of, in my opinion, headwinds just over the next 60 days or so as we get to the inauguration. I don't think the market's considering at all. And they're just, in terms of valuations, I mean, I heard a gentleman on this morning on CNBC talk about the Buffett indicator, something that we talk about all the time. That's market cap of the S&P 500 over GDP. And now you're talking about levels probably north of 180% or so. And that numerator continues to go up, and that denominator is not going up anytime soon in the form of GDP. Now, yeah, maybe this time next year we'll have a different conversation, but you have to wonder how forward-looking is the market and how much good news are we pricing in. And I would suggest we're pricing in a considerable amount and looking past any potential headwinds that we're facing. And oh, by the way, those headwinds are significant. And oh, by the way, you know, there's still a very dangerous period of time from now until, again, the spring, where businesses are going to close. You know, people are, you know, the funds that have been distributed to people seem to be waning. I mean, there's just a lot of things we have to take in consideration from now until then.
That's, I think, really the most important thing right now, is that expanded unemployment benefits for, you know, our citizenry, you know, ran out on July 31st, you know, with the likelihood of a new, you know, fiscal stimulus package hitting, you know, February, March, maybe. You know, we're getting to a point where we're starting to see some of the data on employment slow down. That's not a great setup. You know, so let's look at this S&P chart here. Can you see this here, Guy? I've done two things, okay? We took that September 2nd high out last Monday, but we failed, and we spent some time all last week below it, and look what we did on the news today. We kind of gapped up above it. I think that intraday high from last Monday, which gets you to about 36.46, is going to be something to keep a close eye on today. You know, I think that I read, you know, this would be the biggest November rally ever, or at least in the last 50 years. If we were to close right here, you know, that intraday low was 32.11 or something like that, I think, on the second day of November here. So we're breaking out. I mean, listen, you know, I look at this chart and I take it back to the February high, right? And that's just below 3,400. I think you have some clear levels to kind of trade against here. If we fail at last Monday's high and we close below 3,600, then you have some room down to that 3,400 range. And then I guess under the worst case scenarios between now and the end of the year, and what would those scenarios be? The virus raging, the therapies not working, our hospital system getting overloaded, Trump making a ton of news and having some sort of unrest. And then you have the market pressing back towards that double bottom low, just above 3,200. What's your take on the S&P? And then let's move to the VIX.
Well, we're clearly at the upper end of the range. I think you illustrated it really well. We're bouncing up against the levels we saw. I think it was probably August or so. So, you know, my sense is this is going to put in a near-term top. By the way, you're going to have huge gaps in the chart on the upside that typically get filled. What does that mean? You have a gap open higher last week, another gap open higher again. Those gaps typically do get filled in. And your point about the headwinds that we face, listen, I'm not certain that you're going to see negative vaccine news from now until, let's say, the end of the year or so. So I think you take that off the table. But the fact that we still seemingly have a bit of a contested election, at least in the form of half our citizenry thinks there's still chance that President Trump emerges victorious. Just a lot of headwinds there. Oh, by the way, businesses closing, restaurants shuttering, groups in New Jersey at least. You know, you go from, I think, a gathering of 50 or so people down to 10. I mean, that's not going to abate anytime soon. You somehow staved off New York City schools closing as well. Just there are just so many things to be concerned about that the market doesn't seem to care about right now. So I think that 3393 level or 3400 that you illustrate in terms of that middle line, that's clearly in the crosshairs, Dan.
All right, are you are you in the camp though that whatever we kind of rally into year end, we kind of pull forward from performance for next year? And the reason I asked that question, the S&P 500 in 2019, we saw really no earnings growth year over year. The S&P 500, the multiple expanded dramatically. We saw 30% gains in the stock market. This year, we're expected to see earnings decline probably somewhere between the high teens and mid 20% when it's all said and done. I suspect maybe it's in the high teens, and we have an S&P 500 that's up more than 10%, right? So at some point next year, a lot of the EPS estimates for the S&P 500, which is what it should be trading off, are not suggesting growth of over 20% after being down 20%. So we don't get back to peak earnings for the S&P 500 until 2022. And then you ask yourself, trading at 21, 22 times, how much should the S&P go up next year? So to me, anything we get between now and year end, I think really takes away from 2021 performance. And while you're speaking, I'm going to pull up the Vix chart, and you've been spot on with a lot of commentary regarding the Vix. So let's follow that up.
Yeah, we've done a decent job in the VIX, and I think you make a good point about pulling forward performance. And and we're going to talk about this in a few minutes, but the counter to that argument is there's going to be this huge rotation that potentially could last years, if not longer, in the form of these growth stocks that have been just unbelievably on fire, from those stocks into the value names that are actually doing well today. But we'll have that conversation. So maybe that's the next catalyst for the broader market. We shall see. In terms of the VIX, I remember talking about it prior to the election. The VIX was trading right around here, 23.5, 24. And I said, in my opinion, the VIX is not pricing in what potentially could be a contested election and a lot of the headwinds that we face. And I thought the VIX could trade up to the June high, which was either side of 40. Well, lo and behold, that happened. And, my next point was, all right, now we've priced in all those things. I think if the election isn't a disaster, which it turned out not to be, in terms of the vitriol and some of the, it could basically trade back into the high 20s. But I will tell you that I didn't think it was going to trade down to the current levels we find ourselves at. All that said, Dan, and you've illustrated it, this level, this sort of 22.5, 23 level, has been huge support now, basically since that huge breakout in March. My sense it'll be support again, and you trade around that. So what I would be looking for, if you're looking for a catalyst in terms of a market reversal, a big up day in the market, which we obviously have today, but that coupled with a big up day in the VIX, we don't have that yet. But if you were to see the market sort of trade sideways from here and the VIX creep higher and close up around the 24.5, 25 level, again, not suggesting it will happen, but if that does happen, to me, you're within a day or so of a big reversal in the broader market, Dan.
Yeah, on a very near-term basis, I would just say that the thing that kind of breaks the VIX below 20, I think psychologically that would be a big level, because it takes you back to that gap that we saw in February, right before the market topped out, and then really the market crashed over the next few weeks. What would we need to see here? We need to see, the spikes in the virus kind of come down dramatically. We need to see therapies working really well. We need to see that mortality rate continue to decline. And then, fiscal stimulus, really, if we saw Congress, and even in a lame duck session, come together and start talking about the need to do this quickly, the Fed continues to jawbone, trying to kind of talk rates. We're going to talk rates a little later, down a little bit. And all of a sudden you say to yourself, aside from the pile of debt that we've accumulated to just kind of get us where we are, we can really start pricing in what a reopening trade looks like for the whole economy at some point in Q2. Then you have a VIX trading in the teens, and then you have an S&P 500 using that 3,400, 3,600 level as support, as really a launching pad. But that's a very rosy scenario. Okay, let's talk about that rotation that you just mentioned here. We're seeing last week, clearly after that Moderna news, we saw energy, we saw financials, we saw industrials, cyclicals, just value. We saw the Russell 2000. We can talk about that in a second. Make a new high last week. So the question I have for you is that money coming out of mega cap tech, which has been growth, which has been really defensive in a way, despite some of those high valuations, we've seen them stall out a little bit, and we're seeing new highs, or we're seeing relative new highs on some of those more, I guess, you'd say cyclical sort of names. what's your take on that? Let's start with the NDX, and then we can kind of move to some of those other small caps and that sort.
Well, you've had a nice trend line in the Nasdaq in terms of that, that uptrend since March low. We obviously topped out, I think, in August, had that pullback, retest of that line. Now here we are again. So the question is, are we going to once again test that uptrend line? And that would probably come in the form of a new all-time high in the Nasdaq, just off of, as Dan would say, not necessarily time decay, but how the line continues to go higher as time progresses. So I happen to think we're going to run out of room here, and you're going to see that rotation out of the growth names into the value names. And obviously the Nasdaq is higher right now. It's going to be fascinating to see how that closes today. I think you have a very good chance of having a huge double top in the Nasdaq. That uptrend line was broken. It was retested. I don't think it's going to retest again. And I think that 12,400 level that we made an all-time high at stands up. So I do think the rotation is real. I do think you're going to continue to see it. Maybe these big cap tech names hold on for a while, but I do think there's a very good chance the bloom is off the rose here, Dan.
Yeah, I would just say this about mega cap tech is that as long as they can continue to consolidate and not really, the fundamentals remain strong, the technicals are really just in a consolidation phase after a big period. I guess I'm less concerned about them, and I'm going to tell you why. I mean, just look at from that September 2nd high, that was somewhere at 12,400 or so. We just kind of been banging in between 11,000 and 12.4 or something like that, or 12.3. I don't mind those stocks consolidating there. And I'm just going to pull up, one chart right here, the big kahuna, Apple, which is obviously, I don't know, a disproportionate. That thing's setting up pretty nicely here. Obviously, valuation's an issue, that sort of thing. So I think the longer that the growth names, the mega cap names correct over time, the better the setup it is for them. And I just want to make one other point is that if you think a headwind for mega cap tech is regulation, well, I'm going to bring you Google's chart right here. This is Alphabet, right? And so if I look at somewhere between 1,500 and 1,600, that's where the DOJ slapped that lawsuit on them, which is a precursor to what we might see in a Biden administration for some of the other mega cap tech. It hasn't been too bothered about that. These guys have such massive balance sheets. The likelihood of these companies being broken up are not particularly great. So if it's literally just kind of paying fines and rejiggering some stuff, that's not the end of the world for these companies. They always knew that was on the other side of this sort of thing. So, that's my take on the NASDAQ. And real quick, and I think you make, I'm not looking to play stock market here or talk about individual names, but in terms of Alphabet or Google, I would say that's the one outlier in terms of that had been an underperformer against its peers for such a long time. Yeah. And now it seems to be outperforming, but rightly so based on that last quarter, which was outstanding. If you remember the day they reported, that stock during the day rallied, I think, 8 or 9%. You threw another 5% on in the aftermarket. And my comment on the show that evening was, I can make an argument that Google up 13% from yesterday's close is actually cheaper than it was yesterday. And I think you could still make that argument now. So although Google looks like it might be overextended, I think that's the one stock to me that actually makes sense in this environment on valuation. Anyway, I just wanted to throw that in. You did cogently make that argument. Hey, one of the things I just want to mention, because obviously there's some new traders in this NASDAQ, in this Nadex, game that they have going on here. I can't tell you how much, we talk to a lot of new traders, people who maybe been investing long-term, but thinking about trading short-term. I think the idea of paper trading in a competition like you're doing right now, where, you have the opportunity to win even by not making money in the markets, but by testing some of your strategies, I think that makes a ton of sense. And I also want to say to some of these, just to kind of see what works and what doesn't. And so paper trading, I think, is a great way to start, out. The other thing I mentioned is, why are we focused so much on these charts? Well, they kind of work. Not they don't work as the only reason to kind of get into a trade or do a trade, but they really help at least, kind of give you a sense of where support and resistance might be, informing where your targets might be, where you want to cut losses on an individual trade, or where you want to get longer on a particular trade on a breakout. And I'm just going to pull up this Russell 2000 chart because, this is the first new high in a very long period period of time over the last week for this index. It really lagged the S&P 500, the Nasdaq. Why? A lot of the components, smaller cap companies, were meant to be more economically sensitive to the sort of recession that we're in. If there was some sort of economic sort of backlash, or at least from a capital market perspective, access to capital, these are companies that would be more at risk. So let's talk about this Russell 2000 really quickly, Guy, and what's your take on this?
Yeah, I think you bring up a great point in terms of economically sensitive, and it's no coincidence that the Russell, whether it's mentioned in IWM or how Dan has it up now, is a basically, you throw up a yield chart, which we'll have up in a minute, and they basically mirror each other. So as yields have gone higher, I don't think it's coincidence that the Russell has gone higher. Now you can have a conversation, or we can have a debate whether or not that's justified. And I would submit that the move in rates, rates go higher for the right reasons and the wrong reasons. Rates go higher for the right reasons because the economy is improving. For the life of me, although some data suggests yes, others suggest no, from where I stand at least, the economy is not improving anytime soon. But the bond market is going lower, rates are going higher. Rates going higher for the wrong reason becomes a little bit dangerous. And then you have to ask yourself, again, this question, is the Russell reflecting the wrong thing? Now, price is truth. I say it all the time. People combat me on that, and they at me on Twitter. What I'm saying is the only thing you have to base your decisions on are the levels that you're trading against. So although you might not agree with where it is, the price it's trading at is where you're basing all your decisions on. I think I look at the Russell and say to myself, if rates start to back up a little bit here, and if we've topped out in terms of yields and bottomed out in terms of the TLT or whatever instrument you're trading, here's an opportunity to look at the Russell. If you've been long, take some money off the table, or if you tend to be more aggressive, potentially this is something you could enter a short position in. Again, just looking at the tea leaves, not making any recommendations, Dan.
Yeah, I mean, listen, I guess the point is this, is that if we get into a period where, some of the stuff about the presidential election dies down, we're really likely to get into just the conversation about this Senate runoff in Georgia, January 5th. This is going to be a big one. We thought we were done with election season. What's important about this is that if the Dems were going to win those 2 seats, if they were to win those 2 seats, and I don't think that's particularly likely, then, Biden, the Dems have control of the House and the Senate, and that makes it more likely that maybe some more of their progressive policies, that could be higher taxes, it could be greater regulation, but it might be offset by greater fiscal and infrastructure spending. So who knows what that's going to happen. But I guess the point to wrap all of this up before we get to rates is that, S&P 500 breaking out, the Russell breaking out, the Nasdaq consolidating, it all looks really bullish on the charts here. But we have one more political landmine, and then we have that other thing that we just can't kind of get our arms around, which is the virus, and we do not know what mitigation impact is going to be on the economy near term. So I guess I'd just say that. Let's go to rates, Guy. You just kind of highlighted, kind of your thought on good rate move versus bad rate move. Where are we right now? And has the fact that we've kind of, it's kind of petered out just below 1% in the 10-year Treasury yield, what does that tell you right now?
Yeah, it's interesting. So you go back, I think it was June 8th or so, in my memory, if memory serves, and that's when the last time we saw yields at these levels, or that's the last time we saw a bond sell-off of this magnitude. So again, the question is this a level where you're starting to fade the move? Again, I understand, I get why rates are going higher. The vaccine, oh, that's a great picture, by the way. The vaccine news of last week, and obviously the vaccine news today, the market's pricing in a return to a more robust economy. And you can see it vis-a-vis the airlines, the restaurants, cruise lines, all those different things. The question is, there's a long way to go from now until then. And, is the market pricing in too much? Is the bond market pricing in too much? And I understand markets forward looking, and I totally get it. But here's a level in terms of yields that we failed at 4 or 5 months ago. My sense is we're going to fail at it here again, Dan.
All right, so let's just talk about this for a second here, because Fed Chair Powell, every time he has the opportunity, he's been encouraging the White House, Congress, to kind of really grab the baton from the monetary stimulus and get going on the fiscal here. We haven't had a new fiscal, plan since, I guess, the CARES Act went in place in March, and the money started hitting. But we have a lot of industries, like you just mentioned, forget the big the transport ones, the travel, the hospitality, that sort of thing. You know, there's a lot of small businesses that are really struggling right now, and they depend on, you know, they're really going to be dependent on a lot of this money flowing through. What's your take right there? And so why have rates gone up? The Fed hasn't wanted that to happen. You know, we have this 210 spread, you know, steepening to 1-year levels, that sort of thing. So why are rates going up if the Fed is doing everything in their power to talk them down?
Well, I mean, it's interesting you say that, because the Fed, although the market seems to think, or though Fed watchers seem to think that somehow the Federal Reserve or central banks can control the entire yield curve, the reality is they can control only one portion of it, and the market controls the rest. And you know, there's a chance here that you could lose control of the bond market. You see this huge spike in rates, which I think they want to a point, but they want to see it in an orderly way. I think the real concern for the market is that you see a spike in rates in a disorderly way, not unlike we saw a huge move to the downside in rates back in March. Bond volatility is not necessarily a good thing. And, you know, if you look back over the last year and a half, when you've seen huge move in bond volatility, you've been a week and a half away from a huge move in equity volatility. And again, the moves of this magnitude in the bond market, you're talking about a 10-year yield, which seemingly, you know, 3 or 4 months ago was trading 53 basis points, now flirting with 1%. You can do the math in terms of that move. That is a significant move in something that should be the most liquid, non-volatile instrument in the world. That to me is a little bit concerning. I think if you're hoping for stability, you want to see the bond market, the 10-year, sort of falter and sort of plateau around the 85 basis points or so level. I think that's in everybody's best interest. In terms of Fed Chair Powell, real quick, he's made it very clear, you know, they'll do what they can do and they will continue to do it, but at a certain point, we need to pass this baton from monetary to fiscal. He has said it on a number of different occasions. And oh, by the way, every time he said it, the market hasn't really liked it, because I think they understand some of the ramifications behind that, Dan.
All right, so let's look at the TLT, the ETF that tracks the 20-year Treasury yield. Obviously, it's the closest thing we have in terms of just an equity-linked instrument for the 10-year Treasury yield. You know, you had that breakout above 150 or so early this year. You saw that crazy yield volatility. So the point is, if you're buying the TLT, you're making a bet on yields going lower here. Do you think that we see the TLT move lower in line with maybe a retest of that 1% level in the 10-year Treasury yield? And then do you think the TLT is a buy at that prior breakout level?
So 153.5 or 154, I think, was the close. Again, I think on June 8th, and you have a longer term chart there, but if you make it shorter term, you'll see exactly what I'm talking about. That's sort of your line in the sand, and that should be something, you know, that I've been watching in terms of a tell, and it's worked so far. You have, you know, if you draw the line, there's a downtrend line basically from August that if we, I think, close above 160 or so, we're probably going to break. That's the other line I would be looking at as well, Dan. So again, I think for the short term, we held. I thought yields were going to go higher for a while, but we'd fail we would fail at the 95 basis points mark or so. Or in other words, we would hold that 154 level in the TLT. I understand there's a lot of holding, but you understand how rates move and counter to the underlying instrument. I think we're going to probably hold here and test that 160 level. Close above 160 suggests a breakout to the upside, which suggests lower yields, which suggests maybe the Russell is toppy, and then you can start to do the math from there, Dan.
All right, I'm drawing some lines in the Dixie, the U.S. dollar index here. We don't have a ton of time left here, Guy, but I want to kind of get this one. I know that we've been chatting about this over the last few weeks on the setup, brought to you by our presenting sponsor, Nadex and IGUS, over the last couple of months, which has been a lot of fun. We hope that you guys are tuning into that every Tuesday, midday or so. What's your take on the Dixie here? I know that's obviously pretty well related to your views on rates here, but this one, you know, really banging around on that low end of this 3-month, 4-month range here. It feels really heavy.
Yeah. And, you know, if I'm being consistent, you would look at that chart and say, well, Guy thought the TLT held and it's going to bounce. You think the same thing in the U.S. dollar. And here's where I sort of take the other side of that. I think there's a real problem here with the U.S. dollar. And the only reason the dollar hasn't really collapsed is because rates have gone higher. I think if rates were to start to go lower again in a meaningful way, you're going to see the dollar, that Dixie that Dan has up, break below 90. So I think anything that happens from here until this time next year is going to be dollar bearish, because if you see stimulus, that's going to be dollar bearish. I think anything on the horizon probably lends itself to the dollar going lower. The problem with that is probably the market is set up for it, but I think you shook a lot of people out when you saw that Dixie spike up to, I think, 94 or so a couple of weeks ago. So I think that shook out some of the weak shorts, and I think the trend is I think that still the long-term future for the dollar is lower, and you wonder at a certain point, weaker dollar is equity bullish, but at a certain point it ceases to be, and we probably find that below 90 in the DXY, Dan.
All right, I got GLD. That's the gold ETF here. This is near and dear to your heart. You had a great call. It was an epic breakout above that downtrend from the August highs. You were kind of playing for that, but then all of a sudden that Pfizer news came last week, and you saw a massive gap below that. It's kind of flirting a little bit with that downtrend. Again, this is pretty linked to the rates and the dollar conversation, a little bit of a different animal, especially when you see Bitcoin going berserk over the last few weeks, and gold has really held this downtrend other than that one 36-hour period about a week ago. What's your take here? Because I mean, it's a pretty orderly sort of sell-off here. It looks like it could be poised if it can hang out and kind of hold that September low for another move back to possibly 190.
Yeah, the gold story, although I understand, you mentioned gold sold off on the Pfizer news, and obviously with the news today, I understand that, but gold is not, the view in gold, the trade in gold is not predicated on a vaccine. It quite frankly has nothing to do with it. The trade in gold is a view that central banks globally are trying to devalue their currencies, and we continue to try to do it here in the United States, and that all lends itself to the gold market going higher. The headwinds of gold over the last couple of weeks had been that bounce in the U.S. dollar that's since abated, and has been the news on the vaccine front, and to a certain extent has been the fact that the equity markets have rallied. But I think gold is, again, the next setup, the next leg higher. We find ourselves right around these levels. We've held, Dan has that red horizontal line. We seem to have held it. I think we break out through that downtrend line, and I think we're going to test the levels that we saw against late July, early August, Dan.
Okay, cool. All right, so let me just in a nutshell kind of wrap up where I think things are, and maybe you can kind of piggyback on that. I think all the vaccine news over the last week has been fantastic. It's been a bit of a kind of sell the news, but it really, the one thing that, there's two things that I think this market rally is lacking. So if we were to look at the S&P 500 again and say, okay, 3,600 now because we've broken out above that, that's going to be the new support. There's two things that I think we need. We need to see a Trump concession. I think if Trump were to concede in a formal sort of manner, I think the market cap's higher on that. I think it gives us more support at that $3,600 level. We'd also need to see some of these mitigation attempts with the virus really take hold, and then give a lot of people some confidence that maybe the worst of this winter season for COVID is behind us, and then we start getting this vaccine in the hands of frontline workers, whether they be, obviously in hospitals, that sort of thing, and then become widely available in the new year. And then you start seeing some of these groups that have really lagged, just some of the defensive sort of sectors start to take hold. I think keep an eye on retail earnings this week. There's Home Depot, there's Lowe's, there's Walmart, there's Target. Going to be very interesting any sense that they give us on the health of the U.S. consumer, especially with the lack of new fiscal sort of stimulus. And then, that rotation trade, to me, it is not the end of the world to see some of your most favorite stocks, Amazon, Google, Apple, Microsoft, Netflix, go sideways for a while, especially when you consider the concentration of them in the S&P 500 at about 24% or so, those top 5 names, 45% of the NASDAQ 100. Not a horrible thing. Trees don't grow to the skies. You need opportunities to kind of reload on the long side or consider taking profits. So to me, all of that makes a whole heck of a lot of sense. The worst case scenario is things get really ugly here on the political front. The transition is just in shambles. The lack of kind of ability we have to move forward with dealing with a new administration for this virus is going to put us behind the 8 ball. It's going to put fiscal stimulus behind. Those are the sorts of things that I think could really hit the market. But, you know, obviously we all want to be a bit optimistic here. Guy, you gave us a lot of levels here. Do you want to wrap us up and then kick it back to Travis?
Yeah, no, thanks, Dan. Great job hosting. I like when you play the role of the host. I think, no, everything you bring up is right. And I don't think it's the worst thing in the world to see rotation from your MAGA complex or the FANG names into some of these deep cyclical names. I think it makes a lot of sense. If you're looking for a tell today, and again, every day I look for tells. The tell today will be in the form of the VIX. See where the VIX closes. If the VIX closes in the green, with the market at these levels, I think that's trying to tell you something. And oh, by the way, look at some of these stay-at-home names. If Zoom, for example, were to close positive today, I think that's a big tell as well. So just keep your eye on things. Don't be dogmatic. I try not to be. Again, I was raised in the Wall Street of what can go wrong will go wrong, so I'm sort of always been the half-empty person on that front, but it served me well so far, and we'll see how it serves me in the next 65 years. Dan, thank you, and I think we hand it over to Travis, who's been listening intently.
No, this is good, guys. Great 36 minutes. A lot of just great insights coming out of this event. A couple things, folks. As Dan and Guy mentioned, tomorrow, every Tuesday, we have an event that they host midday called the Macro Setup. It's a lot like what we're discussing today. It's 30 minutes of going through what's going on in the world, how's that impacting market, and where's the action at. Again, Nadex, very short-term focused exchange. We're looking for those short-term volatile moves to take advantage of. And there's a lot of macro that goes into that, as you learned today. But there's also a lot of technicals that go into that. And that's why Dan and Guy are so keen on bringing out those technical levels and why those are important, because those are critical in those trade setups as you move forward, whether that's a downside support, upside resistance, whatever that is, and how you structure your trade around that. It's critical that we know that. So these educational events are big in helping us understand how to structure those trades moving forward. The last thing I will say, on the note of fiscal stimulus or lack thereof, Nadex does have a bit of fiscal stimulus that we're pumping back, at least to our new prospects, as well as some of our existing holders, in the form of for all of you newcomers who have yet to open an Nadex account, if you do so, we are offering that 10% initial deposit bonus up to $100. So again, you put $1,000 into that account, you're going to get an extra $100 as a bonus. Additionally, for those of you who have been around for a while, who don't necessarily qualify for the initial bonus offer, what you do qualify for is the refer a friend offer. So get out there, tell your friends about it. For every friend that you refer into the exchange, you're going to get $200, and your friend will get $200 once they start trading. And you can do that up to 5 people. So there's another $1,000 for you right there. So Mr. Rich has posted in the chat panel the link that explains all the details around these offers and the parameters that apply to them, so that you understand how to qualify, and you'll be good to go on that front. So Dan, Guy, thank you again. Looking forward to tomorrow. Another exciting day on tap today, and hope everybody enjoys the day. Let's go get after it.
Thanks, folks. Good luck.
All right, guys.
Thank you.
Bye.